Hello again. It's time for another tax update, tax planning video. Hopefully this one only stays around 10 minutes today. Today I wanted to talk about buying a home as a small business owner. So this is probably like your first time buying a home. This isn't a real estate investment home. We're talking about buying a primary residence, and it's probably going to be your first home purchase as a small business owner. Maybe you've bought before in the past as a traditional wage earner, but buying a home as a small business owner can be complicated, and it has a lot to do with making sure that you know the strategies that have to go into play to do so. So when you buy a home as a small business owner, the bank or the mortgage company, whoever you're getting the mortgage through, is going to want to see a minimum of 2 years of tax returns. And that's because after the 2008-2009 crash on real estate, they changed regulations for the banking industry and said, hey, we're going to make it so that you can only get a mortgage based on your tax returns. And then they said, hey, we're going to use the IRS to make sure people are filing correct tax returns for as a way to audit, per se, that your filings or that your taxes are correct. And then the banks are relying on those correct tax returns to loan you money to buy a home. So there's a couple things at play here. One, they're relying on the IRS to verify tax return information to make sure that what you're giving the bank is correct to purchase a loan. Well, as I tell everyone, cash flow does not equal taxes. They are two completely different things, right? And there are multiple rules to accounting as well. Like there's not just one set of rules. So tax has its own set of rules and its own issues. And taxes are never economically correct or real world correct or cash flow correct. They are based on many different factors. Well, the biggest issue between the banking industry and the tax returns, which they haven't addressed, is that you are only required by law to report your income. And then the IRS just assumes you're an idiot if you don't report expenses. So you're not actually required to report expenses. And this is why buying a home as a small business owner then becomes a 2-year strategy planning to do so. Because there's a catch-22 to buying a home as a small business owner. So the first thing is you go out and let's say you want to buy a $500,000 home. Well, if you're going to put 20% down, that means you have to get a loan for $400,000. Well, how do I know I want to buy a $500,000 home? I've done some quick math, or I've talked to a mortgage lender already, and I know how much I can afford for a monthly payment. That like either I'm already paying rent, say like $2,000 a month, or I have $2,000 a month extra cash, whatever. I know my personal finances. Again, this is all hypothetical, right? These back napkin numbers. But anyway, I would say I know as a small business owner running my finances, I know I can afford a $2,000 a month payment. Oh, after talking to a mortgage lender based on interest rates, projected interest rates, the size of home that I want, blah, 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 blah. Basically, I'm going to target getting a $400,000 loan. These are all things that I have to decide about myself when it comes to purchasing a home. How much can I afford for that monthly payment? Because it's not how much we can get, it's how much we can afford when it comes to purchasing a home as a small business owner. And this is why. So the catch-22 comes into play that, okay, well, now that I've picked out my home or the size of home that I want, I have to decide, okay, I'm planning on getting a $400,000 home. Mortgage lender, what's my targeted income that I need to show for the next 2 years in order to get approved for said $400,000 loan? Then when we file your taxes, we target that number because what will happen is if we don't have a target, then we're just going to say, well, let's maximize your income. Well, that means I report all your revenue with no expenses. And now you're paying, let's say you're making $1 million in revenue, but you throw in a bunch of expenses and you should only be paying tax on $200,000. Well, if we report $1 million in revenue with no expenses, you're going to owe $400,000 in tax. Whereas if we actually reported the $200,000 taxable profit that you had, then you would have only owed $20,000 in tax or something like that. So that huge difference, right? You probably don't even have $400,000 to pay that tax. All right. So we need a target, because the other thing is we don't want to be below that targeted amount, because then you're not going to get approved for the loan you want. So it's all a game. And so the more we report income, the more taxes you pay. Well, we still have to consider that 20% down payment. So if you have to make a $100,000 down payment and you have $200,000 cash available for down payment and paying taxes, then we definitely need to target that exact amount or very close to it to get you approved for that loan. So that way you have the most funds available for that down payment. Because if you over-report income, you're going to spend all your cash in taxes, and then you're not going to have anything for a down payment, and you're still not going to get your home. So it's a 2-year strategy, and we have to have a target of what you want to hit to be able to do that. So then we say, okay, well now we have this targeted income, and let's say I want to buy $500,000 home. I'm going to have $100,000 down payment. I'm going to get approved for a $400,000 loan. The mortgage lender wants to see me make, over $100,000 of taxable income for 2 years. Well, I can come in and I can say, okay, I have all this revenue, and then I have all these expenses, and then we have all the directly related expenses, and then I have all of these aggressive expenses that we take that I don't necessarily need. Like I can, they're great for saving taxes, but they're going to be what kind of hurts me if I report them, because now I'm not going to get approved for the loan. So we say, okay, we're going to pull those out and we're going to send them to the side and hang on to them. And we're going to go ahead and file your taxes. And then you have to pay your taxes, because the other thing is if the underwriting, the lenders are going to pull your tax transcripts. And if the IRS shows that you still owe money, that's another debt. And so that's going to affect your debt to income ratio, and you're still not going to get approved. So you have to actually pay the taxes too. Okay. So I'm going to say, okay, I'm going to target $100,000 of taxable income for 2 years. I'm going to remove some of those expenses so that I hit $100,000 pretty close to that, maybe $102,000 or $103,000. I'm going to be over, but I'm going to be close to it. And then I'm going to pay the taxes that I owe, where like $10,000 or whatever it is. And then I'm going to have my money for a down payment. I'm going to do that for 2 years. Then when I go to actually buy the house, I'm going to, okay, here's my 2 years of tax returns. I get approved for the loan. I close, I move in. Well, we have up to 3 years from the date of filing to amend your taxes. And a great reason for amending taxes that is used all the time is, hey, we had an accounting error and we didn't include all of our business expenses. And so we amend, we put those expenses that we were hanging on to back into the tax return. Now you get a refund of what you had paid in taxes. So it's kind of a game we have to play with the idea that I'm going to pay extra today. I will hopefully get it back in the long run, but it also allows me to get into the house that I want. And so again, it's more about understanding your personal finances and what you can afford as a monthly payment versus what size of home I can buy. Because if you're making $1 million in revenue, I can, like I said, I can wipe out all your expenses, and you're going to get approved for a $5 million home. But can you afford the monthly payment on a $5 million home? Especially if your actual real world profit's only $200,000 a year, right? And so that is what you have to consider when purchasing a home. It's a catch-22, a double-edged sword. But if you play the game right and you start thinking 2 years in advance, we can set your taxes up so that you get approved, you get into the house, and then we amend and you get your money back. Now, this is aggressive. You're not committing fraud. You could debate that it might be unethical because you're playing the game. But that's, everybody's going to have an opinion about what is ethical and what is not. But that is, you're not committing fraud because you are following the tax rules, which are the rules of I report my income. I don't necessarily have to report on my expenses. And then it's not our fault that Congress told the banking system to use tax returns following a totally different set of rules to approve mortgages, when mortgages should fall under more of an economical, real world standpoint to get approved for. But these are the rules that they've set. So our goal is to understand the rules so we can play by the rules. When we understand the rules and we can play by the rules, we can then use the rules to our advantage. And this is one of the ways that we can do that. So you can, but it does take planning, it does take some strategizing and some forethought. And you have to go in and talk to that mortgage lender and find somebody that's willing to give you that target. This is what underwriting is going to want to see on your tax return for 2 years, because we can manipulate that. Okay, so keep that in mind when you're going to purchase a home. It is a 2-year process. You need a targeted income to show on your tax return so that we can meet that target to make sure you get approved for it. And really, it's not going to be the lender, it's not going to be me, it's not going to be anyone else that tells you, well, what can you afford that you understand in your own situation. Once you know that, you pick up size of home that you can purchase. You talk to the mortgage lender, you get our target, we target that on your taxes, you pay your taxes, you close, you move in, we amend, and you get a refund. Now, I do charge extra time for amended tax returns. So that's not like something that's included in the original tax return filing. If this is a strategy that you're going to use, that is additional work. It's an out of scope, what we would call an out of scope project or a one-time off thing. So there would be time charged on amended tax returns. Okay, so that is buying a home. What about selling a home? So if you are selling a home, if it is your primary residence, so the technical rules are you've had to live in your home for at least 2 of the last 5 years, and then we can call it your primary residence. And as a primary residence, it's something like $250,000 of capital gain for single is tax exempt, and over $500,000 is tax exempt for married, filing joint. So really, you have to have a significant appreciation on your home in order to actually owe any taxes on it, which I'm saying is like you've lived in this home for 20 years. Because unless the market is just growing at such an exponential rate that you're doubling or tripling the value of your home, because even if you buy $1 million home, you're going to have it be worth 2 million, or before taxes are even going to be due on it. Because the next thing is we're going to take into account any money you've put into the house, any remodels you've put into the house, any of that kind of stuff is going to be decreases in the amount of capital gain that you have. So really, there has to be a very significant increase in value. Like you inherited the house, you lived in it for 20 years, and now you're selling it at a huge capital gain. Yeah, you're gonna owe some taxes on that probably. Okay, so that's the actual rule. If it's an investment property, you're gonna owe taxes on it. If it wasn't your primary residence, you're gonna owe taxes on it. And if you lived in it less than 2 years, you're probably gonna owe you should owe some taxes on it. Okay, so that is the rule. Okay, well, key word here is primary residence. So when you go to sell a home, the realtor is going to ask you, they're going to have you fill out a questionnaire. Is this your primary residence? Just mark yes. Well, what happens if you mark no is at title, when you're closing at titling, the title company will issue you a 1099 stating that you had a sell. Now, they don't report your equity in the home, they only report the sales proceeds. So if you sell a $200,000 home that you bought for $200,000, you sold it for $500,000, they're going to say that you had a $500,000 gross proceed on that 1099. If there is no 1099 filed, we don't even have a reporting requirement because you owe no taxes on it if it's your primary residence. So if you tell the realtor it's a primary resident, you're not going to get a 1099. If you tell the realtor it's other than a primary residence, anything else, a second home, a investment property or anything, you're going to get a 1099 on it. Okay, so keep that in mind. So I'm not telling you to say it's your primary residence if you only lived in it for 1 year. I'm just saying if you consider it your primary residence, tell them it's your primary residence and you're not going to get a 1099. The other thing is, even if you do get a 1099, chances are you're not going to owe taxes because 1 year they're going to fall into that exemption, right? Or we're going to do a really good job of coming up with other expenses to put into your house, such as remodeling, painting, anything you've done to it, repairs over time to decrease that capital gain that you have on it. And so even if you've only lived in a house a year, if you were to get audited and we hadn't reported as taxable income, even if you get audited, there's a very good chance that you're still not going to owe any taxes on it, merely because if you've only lived in a house for a year, the amount of appreciation that's going into that, like I said, unless it's just skyrocketing, isn't going to be enough to result in any capital gains tax because you've probably got expenses in the house, such as something. You know, there's something that you've done to this house to create additional expenses to lower your capital gains. So the best thing you can do when selling a home is to just tell the realtor that it's your primary residence to avoid getting that 1099. Now, I'm not telling you to lie. I'm just telling you if you can claim it as a personal residence. But if you still get a 1099, then we have to report it because the IRS knows about it now. So we do have to report it, but there's a good chance you're still not going to owe any tax on it. Then the other thing is even let's say you actually do owe some tax. Let's say you got the 1099, we threw in all the expenses we could. If you've lived in it longer than a year, we now have what's called long-term capital gains. And those go on at a different tax bracket. And the brackets are 0, 15, and 20. So let me just pull up the long-term capital gains brackets. I can find them real fast and then I can share a screen with you on this one. All the pop-ups came up and so that's messed up where I was. Here we go. Okay, I'm going to share screen and show you this so that you'll get what I'm talking about. Okay, so these are the long-term capital gains bracket, long-term capital gains tax rates or brackets for this is for 2020. Let's go down to 2023 because that's what year it is. So if you're single, you don't pay tax up on anything when you've earned up to $44,000. Okay. Then it jumps to 15% on $44,000 to $400,000. So let's say you sell an investment property, or you've sold a second home, or you sell your personal home, your primary residence, but you're only in it for a little over a year. We're going to fall into this long-term capital gains, and then we're going to say, okay, you have this. You bought this home for $200,000. It doubled in value over a year. Wow, that's crazy. And we sold it for $400,000. So we have a $200,000 capital gain. And then we're going to say, well, we came up with $50,000 in additional expenses that you put into this house. So that's one of the reasons why it increased in so much value. So now we only have $150,000 capital gain. Well, if you're single, then we're going to take $44,000 off of that. So I'm going to subtract the $44,000 because that's tax-free. And now you're only paying 15% on $106,000. So your taxes are going to be almost $16,000 on that, on a $200,000 increase in value. After we took some expenses towards it, you're only going to pay $16,000 in tax on that. So if your capital gains are under this 44, if you're married under this $90,000 limit, you're still not going to owe any capital gains tax on it. You still don't owe any tax. And so most likely what's happening is, like I said, unless the market is just super skyrocketing overnight, then chances are, as long as you've lived in it over a year, you're not going to owe any tax on it, because even if you do calculate a capital gain, it's probably not going to be more than 40,000 or 90,000. And so you're still going to fall into the zero tax rate on your capital gains. So even, like I said, even if you get a 1099, you're probably still not going to owe any tax. But the best thing you can do is just say, hey, it's a primary resident. You avoid the 1099 reporting anyway. And even if you technically had a capital gain that should be subject to taxes, you're probably still going to fall into this 0% tax rate once we actually calculate everything. So there's still very low risk that you would lose an audit if an audit even comes. So that's just my quick strategy on buying a home and selling a home, whether it's your primary residence or investment property. Now, there's a whole bunch of other things that come into play when it's an actual investment property, because we could do like a 1031 like-kind exchange. We can, do the whole plan is cost segregate and flip every 5 years, and that means we're doing a 1031 like-kind exchange in 5 years. But anyway, buying and selling of a primary residence, lots of a 2-year plan, 2-year tax plan strategy to buy, and then just make sure you tell them it's your primary residence when you sell, and that will avoid a lot of your taxes. Anyway, thank you. Hope this is helpful for some people.